Welcome to another episode of the Career Evangelist Podcast. Today, we have a very special guest who is making waves in the real estate investment world. We have Nic DeAngelo with us. Nic is the CEO and founder of Saint Investment Group. Nic oversees an impressive $206 million portfolio spanning over 20 states in this country. Nic is experienced and is here to share his insights on real estate investment. He's going to talk about inflation, and we are going to talk together about how to start investing in real estate. Without further ado, let's welcome our guest. Hey, Nic, thank you for coming on the show.
Bola, it's really great to be here. It was great catching up with you a little bit beforehand, and I'm excited to talk today.
Awesome. So yeah, when we were catching up, you mentioned that you were once in corporate, right? So can you tell us about your journey? How did you go from being a corporate guy to starting your own business? I think you've started not just one, maybe more business and you sold some. So can you please share your journey with us?
Absolutely. So I've started a number of businesses, some more successful than others. We have 3 exits that were combined into one big exit. So 3 companies that were sold into one exit. I learned a lot from that process, but really I started very early on, my early teenage years in construction. And that I didn't like that. It was really, what we do today. I might work a lot of hours, but it's not as hard work as when I was working construction. That's tough, tough work.
I agree.
I dug ditches for 12 hours a day. Wouldn't recommend it. Very difficult work. But then I entered corporate. I said, well, hey, I want to check out what corporate America has. I was about 16, 17. I convinced a local bank to hire me. And that was my first, segue into corporate America. I wore the same blue suit that was off the rack. That didn't fit me well at all. I didn't, I wore that every day for several years and just I couldn't afford anything else. But I learned a lot. And I was so young that I had the advantage of sticking out because I had a suit that didn't fit. I was very new. I was very fresh. I was always asking questions. I even got the attention of the CEO at this local bank. I asked if there's anything I could ever do to help him directly. He kind of like laughed it off. But I ended up being able to make some PowerPoints for him and help him with some tech stuff that nobody in the company really was doing at a high level at that point. It was a smaller bank that went on to be very successful. So he's now a dear friend today, and he's still a mentor years later. I don't know what, 20 years later, he's still a mentor. From there, we went on. I ended up working with some family offices. I said, hey, I want to get to the investment side of things. And I moved towards the family office side, very corporate, multi-generational wealth. Again, I was too young for the job, but had to negotiate my way into the job. So I've gotten to see the corporate world in a few different settings and a handful of different settings. And I think there's huge opportunities for it. The entrepreneur world is very close to my heart. That's kind of what I shifted into thereafter. But the corporate world has these huge advantages of allowing an individual to really be fantastic at a specific focus. Whereas the entrepreneur world or the small business world, you wear a lot of hats. And that's a great thing because the opportunity's there and there's some upside potential in a lot of big ways. But the downside is you kind of have to be more of a jack of all trades. Whereas I have some friends and some people that we've ended up hiring at Saint that come from a very corporate background that are absolute unbelievable world-class talent at a very specific thing that sometimes I think is missed in the entrepreneur community, or is something that you're not able to focus on and educate yourself so deep onto one focus. So that's a little bit of my corporate background and my experience kind of being more in the professional corporate setting.
That's awesome. And Nic, thank you very much for sharing that story. I think that's impressive and inspiring. So I want to hear from you, what's really inspired you to found Saint Investment Group, and what are some key strategies that have driven your company's success today?
So I think that the market is bigger than any of us. It's bigger than you. It's bigger than me. It's bigger than any listener, or the market drives what businesses end up doing. We are all in the tides of the market. So when I was really stepping in with these family offices, these investment groups, and these kind of larger corporate machines where a lot of money's flowing, there's a lot of defined roles and kind of a growing business. The issue was, it was the worst market that we had seen since the Great Depression when I entered. It was the wake of the 2008 global financial crisis, right?
Yeah.
So when I stepped into that role and I said, hey, I want to work for you guys, I'm going to do the best I can and I'll be this amazing asset. I thought that the best bartering chip that I could do at that time was to work for free. And again, I was in my very early 20s. I had no kids. I got a bunch of kids now. I had no wife. I had no family situation. I had no mortgage. I had no expenses. So
Yeah.
for me at that time, I looked at it like I need to go work around the best people in the world at what I want to do and invest in real estate and learn investing from these people. So I said, hey, I'll work for free. Don't worry. You don't even have to pay me. And I thought that was a shoe-in. And these ultra successful, CEOs, these companies said, I can't afford you for free, because then I'd have to train you. Then I'd have to have a desk for you. You take up the team's time. We're holding on for dear life. We actually don't have time to train you. So that's where corporate was at. That's where the business world was at that time. Was they were firing so many people in so many different industries, especially investments, especially real estate, which I was trying to break into, that they couldn't even hire people for free. That's how bad the industry was. So in order for me to make any close progress to the CEO, to the investments, to learn, which is what I wanted to do, I had to essentially negotiate into that role, right? And so for me, it was education was the number one thing. So I didn't have any money. I was very, very, very broke, but I put together about $4,000. I think it was like $4,000 to $5,000. No, it was $4,500 is the exact amount. And I bought a course on buying foreclosures.
Oh, wow.
Okay. And it was the best guy. I did all the research. I asked for a payment plan. I think he gave me a discount just because I was some broke kid that wouldn't stop calling him. And what I did was I took this course to learn how to buy distressed assets. And it was a shift in my thinking of how to buy things below market. So when I got on the other line to the family office and I said, hey, I can get these deals for you below market. I can get assets for you below market. You like making money, don't you? Right? Then all of a sudden, it shifted the focus where I'm not a free employee that takes all this time and effort and energy and resources. Instead, I'm now making them money, which is what they really needed at this point in the market. They needed opportunities to add revenue to the top line. So if there's one thing I learned very early on that I'm very blessed and very lucky to have learned, it's that if you drive revenue for a company, whether they're a multi-billion, multinational, et cetera, or if it's a small business, entrepreneur, mid-sized business, whatever it is, if you are directly driving demonstrable revenue to that company, you're a key employee.
That's absolutely spot on. I agree with that. Absolutely. So now let's focus on real estate.
Absolutely.
Quite a number of people, they want to go into real estate. They want to invest, make their money work for them. What would you say should be and I know there are different ways that one can get into real estate, whether it's residential or commercial, or maybe just buying REITs as stocks, right? What are some ways or ideas that you would recommend to my listeners if they want to go into real estate investments?
I think there's one main decision out of the gates. There's the first main decision. The first decision is, do you want to do the work and do you want to own the properties, or do you want to partner and invest with someone else?
Okay.
Right? That sounds simple. Most people, me included, I thought this early on. Most people think they want to own the properties. They want to go buy things. They want to go do the deals, right? Early on, I thought it was because, oh, I don't trust all these other people. I don't know how they run the business. I don't know how they do things. What I realized, it was mostly an ego thing for me early on, because what I thought was I could do it better. I could make more. My returns would be higher. That's
Right.
really kind of at the end of the day. What I came to realize, now I'm going on, many years in real estate, is, a decade and a half doing this full-time professionally. What I've learned is this, is that the access that most people full-time in real estate, most funds, most investors, most syndicators that do this full-time, the access to deals and opportunities that they have are beyond what the average person has access to. Look, if you do something full-time, you're going to be better at it than somebody who's passive or does it occasionally. So where real estate has gotten is that it's become a split. And performance-wise, the people that do this day in and day out can find better deals for better prices, and also know how to operate those assets better, whether it's reduce expenses, whether it's bump up rents, that I actively invest with quote unquote competitors, and I will beat what most people could go to the market and buy for. So if the average person could go buy a deal right now and make maybe, let's say, 10 to 12% returns, I can go invest with some people that I know are really good, and I can go make 12, 14, maybe even more percent returns. So higher than the average person could do. And I can do it passively, not having to run a whole business around that. Right. So that was a huge mindset shift for me. So the first decision that your audience would have to make if they wanted to get into real estate is, do they want to run the business and start a business and go buy all the assets and go buy all the properties, or do they want to invest with someone else? Typically now in today's market, investing with someone else has the higher returns. So that's first. Second, you have to go into things like, do you want to go into residential or commercial? That's like, different asset classes or asset types. Then it goes into all kinds of other questions of, what do you think the future of the economy is? What do you think, what kind of assets, what kind of type of real estate do you think is going to be driving that economy? But number one, they've got to decide if they want to do the work, they want to start the business, they want to find the deals, or if they want to invest with someone else, because it's a completely different route to get to both.
Okay. Would you say it's more challenging right now, considering the interest rate, the high interest rate regime that we are currently dealing with? Is it because I've been planning to, start buy some properties, but when I think about the interest rate, I'm pulling back that, hey, maybe I should wait and allow the market to cool, maybe the interest rate will drop. So what would you tell someone that is in a similar situation? Should we wait or should we go?
That's the right question, Bola. That's 100% the right question. Here's the thought. If interest rates are high and you're buying a property with a higher interest rate, you're going to make less money.
Correct.
Right? The question is, how can you invest where interest rates work to your advantage? What assets can you invest in, or what strategies can you use where the high interest rates are even a good thing? Right? So what we do today, so at Saint, we've had a lot of different we've done 7 different asset classes. We've averaged 35.5% returns over our career. So we've done a lot of great things, but today's an environment where things are shifting. We have a lot of volatility in the stock market. We have a lot of volatility in different markets. We have volatility in our political process in the US, right? So we're laughing today because in the last week we had, President Biden, who served for many decades in the US, but he said, I'm out, now I'm in, now I'm back out, and he just dropped out as president. We don't even know who the Democratic nominee is right now. It looks like Kamala, but there's a lot of turbulence, and that makes a lot of people uncomfortable, especially the demographic of people that are in the professionals that are the backbone of our country, the backbone of our economy, especially the baby boomer generation with a lot of its wealth that's moving towards retirement. Those are the 2 demographics most affected by all this uncertainty. So to answer your question directly, of how you can invest in that, it's find something that works very well with interest rates. The thing that we found best at Saint and what we're investing in right now is single family mortgages. Okay. So we buy large pools of mortgages. Oftentimes we get a really good discount on those, and we can offer good returns on those. So the higher interest rates go, the better it is for that asset class. Because if we buy mortgages where people's rates are, let's say, 4, 5, 6%, but the market is at 6 or 7% interest rates, what's the likelihood that the assets that we just purchased are going to refinance? It's going to be very low. They're stuck in there. They want their low interest rates.
Right.
They want, and our portfolio on average is 39% equity per property. So they have low interest rates. They have high equity. They don't want to leave, right? They want to stay there forever. So if the market changes, we change with it, right? And so what we're doing is investing in mortgages, and those still pay great returns. We pay between 12 and 14% to our investors, which is unheard of in real estate right now. But it's about choosing the right asset class. What you're saying, Bola, many people that used to invest in, multifamily or apartments, it's not the right time for that. Interest rates are too high. You're paying for too much, right? I think that's a great asset class over the next decade. I think it'll do tremendously well. But today, I wouldn't be investing in multifamily. I wouldn't be buying apartments myself.
Okay, no, that's good. But do you have apartments in your portfolio, or you only buy mortgages?
Oh, absolutely. We've definitely done apartments. We stopped investing in apartments around 2022, I think was our last apartment investment. So the market got a little too hot for us. We wanted to see where that would go, but we love the asset class. It's about more timing right now. So I think apartments are supported by the government. They're supported by amazing lending programs. It's supported by the growth of the demographics of the U.S. The more the population grows up, the better it is for apartments. There's so many great things about apartments. It's more about the timing that's concerning for us right now. And so, like you said, we see, maybe a decade ahead of high interest rates. So what are we going to, we can't just not invest. We got to be doing good investments for our clients. So for us, the best opportunity right now that we found is the mortgage opportunity. So that's what we're investing in, because it actually benefits from this market.
Oh, okay. Thanks for explaining that. So thinking about, you said you have some investors, right? So people out there listening to this show, if they want to invest with you, I don't know if you are still accepting investors or not, but what's the process like?
Sure. So the process for us is, number one, we get on a call and we just make sure that everybody's a good fit, that they're a good fit for us, that we're a good fit for them, that we would meet their needs, and that they meet the profile of kind of our normal investor that we could do amazing things for. So that's number one. Two is we verify that financially that it's a good fit for them. We always want to make sure that we can deliver on our promises to make a big impact for their lives. And then they sign docs and we move forward, and they're getting a check in the mail every single month from there on after. Oh, so we're a fixed income strategy, right? So as people go on, so in my background, I own multiple businesses. We are very successful. We sold them for, great returns, but the issue was the businesses had a lot of highs and a lot of lows. Yeah. That's very common for all businesses, especially for entrepreneurship. So we had some seasonality. We had some things where the net returns were great, but we needed something to balance out our revenues. So I started investing in real estate. I started investing with partners. We ended up buying some properties on our own. We started putting some of those deals together as well. And what I found was I was putting so much money towards real estate that actually the majority of my income was then coming from real estate, even though there's a great successful business. And I looked at it, I said, we're pretty damn good at real estate. Why don't we sell the other businesses that are really difficult, great returns, but, I was working 80, 90, 100-hour weeks. Why don't we sell those and lean into the real estate side, because we're pretty dang good at that, and just bring in more and more investors, because we had a lot of people that wanted to join us. So that's what we ended up doing. And what I found was that balancing my income with the real estate investing side allowed me for appreciation over the long term. We got great returns there. It allowed me for monthly cash flow at the same time. So it was a really good balance to my high paying situation that I was in. I was making good money, but I had to do something with it. So I kept investing.
So I was thinking, when you said you are fixed income portfolio, how do you kind of guarantee that? Let's say I am investing with you. Let's say I'm bringing $100,000, and maybe we said 5%, just putting out some numbers there. I don't know your rate, and you are saying I'm going to get a fixed amount month.
Correct.
I know that, like you just said, everything is cyclical, right? There are times when you get great returns, and there are times when maybe you get lower returns. But how do you guarantee your investors that they are going to be getting month-to-month check?
Absolutely. And that's the question, because if you're investing in fixed income, then one of the biggest questions with fixed income, it's not risk versus reward. Fixed income is stability.
Yes.
Right? How do you have confidence in the investment that you're making? Because if you're saying you're going to make the same amount every month or the same return every year, then what actually backs that up? So that's part of fixed income investing.
Mm-hmm.
So to answer directly is first, there is no guarantee in investing at all. So we can never give a guarantee. So you look at two things, because if you can't get a guarantee in investing, which all of real estate doesn't give guarantees. So if you can't give a guarantee, what can you give? The first is track record. And the second is understanding the business, right? So that you say, hey, this actually makes sense. This could actually do that. So track record wise, we always try to hammer home for investors that we've never missed a payment to our investors, never missed a distribution. So that's in over a decade. And while that might sound like, well, duh, you're not supposed to miss payments to your investors, the whole market on like things like apartments, these very great, well-respected companies are not paying distributions right now.
I know that.
Okay. So I'm sure you're sophisticated and positive, but for anyone that doesn't, big parts of the investing world are not paying distributions right now. And that doesn't mean they're bad companies or bad people. That's where their market is at. Okay. So in over a decade, we've never missed a payment to our investors. And then also during that time, we've never not returned money when someone's asked. So when someone says, hey, I'm in the window of time to redeem my money, I'd like to get that out. No problem. We'll send them a check 100% of the time. We've never missed. So track record's so important when someone's choosing who to work with. That's how we verify it on our end, is to give them some things like that. But more importantly is, how do we pay consistent returns, right? How does a fixed income product pay consistent returns in the market we're in today? We buy at a discount, simply put. We buy at a discount. Our average discount is about 26, 27%. So if we have that degree of a discount, then our net return is somewhere about 18% is usually what we're targeting. So we give investors between 12 and 14%, depending on what product that they choose that we offer. So about 12 to 14%. We make a few percent on the difference, and then we have our own expenses and our own fees of everything we got to cover on our side. So that's basically how that breaks down. And the basis for all of that is what we invest in. So we talked about the single family mortgages. 98% of mortgages in the United States, Bola, 98% of mortgages in the United States are fixed interest rates, 30-year mortgages, right? So there's no asset class in the entire US that has a 30-year time horizon of highly expected payments, right? You can, do US treasuries, I guess, but you're talking, 4%, right? You're talking 4-ish, 5 maybe. But all that to be said, 12, 14% backed by things that have 30 years of payments ahead. So that's what we looked at. We needed long-term stability for what we were evaluating, because the US economy, it has a bright future, but we're just going through some difficult times, whether it's inflation, which, peaked at 9.1% in the middle of 2022, or whether it's interest rates, the highest increase of interest rates we've had in 40 years. Investors need to be careful right now. They need to choose where their money goes very wisely.
Absolutely. And thank you for sharing that. So you manage over $200 million portfolio. So can you share with us some of the challenges and rewards of managing such a significant investment?
So the number one is it's very important for me who I surround myself with. And being in the investment space, there's so many good minds. There's so many good people that we get to talk with. So some of that is just the finance world has a lot of great people in it. And then the other side is our investors are so smart. We get so many sophisticated investors, people that are doing amazing things. They have amazing jobs, very high intelligence. So we put out a ton of free information, because most of our people that invest with us, most of our investors and potential investors are so sophisticated that the more information we give them, the more that they understand, the more likely they are to invest. So it's just a repeating positive cycle. So the people are the number one advantage of what we do, is that we just get surrounded by amazing investors, amazing, smart, sophisticated people that are doing really big things in the US. And then the second is I get to focus on things that I really care about. I really care about the economy. I really care about investing. Those are two things I'm very passionate about, and it puts me close to a lot of things like that. So, it's something that I'm very passionate about. And so it's easy to spend a lot of time doing it because it feels very natural.
That's good. So as we are wrapping it, what advice, Nic, do you have for new investors that are trying to get into real estate investing?
I think it's 3 steps. The first step is you got to choose with which path you want to go. Step 1 is choose the path you want to go. Do you want to be the investor where you find the deals, you manage everything, you manage the property manager, you manage the cleanup, the toilets, the tenants, all that? Or do you want to invest with someone else? In today's market, you'll make more money investing with someone else, but you might want to have a career as a landlord. That's a great thing. I've worked with many of landlords. I respect them. We do that in-house today. So first is, do you want to be the landlord, or do you want to make a little bit more and do you want to invest with someone else? The second is, I recommend going fixed income next, because you're going to get a little bit higher of a return. It's going to be more stable. So especially if you're in a corporate role, or if you're in a position where you have a day job, you have a lot of responsibilities on your plate, knowing that you're bringing in a fixed income next is the second most important thing to me. And that's what I did, and I found the most benefit from. And then the third step is looking for things like appreciation, right? It's looking for things that over time are going to have a much higher return. So those are things like the multifamily syndications, or industrial real estate, investing in industrial syndications, or things where you might be tied up. Your money might be tied up for 5 to 7 years, but you have a much higher likelihood of higher returns. So that's the 3 steps that I would be moving through if I was stepping into real estate today. And it allows you to focus on your career, focus on the things that you can be best at, bring in the most income so that you can put the most towards investing if you choose to do so.
Awesome. So now it's time for our rapid fire question. Nic, are you
Great.
ready?
I'm ready. I'm ready.
What's your favorite book on investing?
Oh, on investing specifically.
Yes, sir.
There's a book. It's by Howard Marks. I'm spacing on the name of it right now. There's a book by Howard Marks, Mastering the Market Cycle is the name of it, I believe. Howard Marks is an amazingly intelligent man. He's very smart on understanding the highs and lows of how an economy works. It really opened my eyes to market cycles and how to do that. So I'd say that's the first one that comes to mind. It's one I read more recently too. So I would definitely reread that again.
Real estate or stocks?
Real estate. Yeah. I'm super biased, Bola. I'm very biased. Okay.
Obviously.
But look, stocks, you're not in the room when they're making decisions. They make those decisions outside of us. So there's great companies in the stock market. It's public. You can trade it very quickly. There's great things about the stock market. I invest in stocks, or I did in the past for many years, but real estate is tangible. You can go touch the building, right? You have tenants. You're working directly with people. You learn about markets differently. There's tax advantages. There's income. There's appreciation. Just stocks don't have all that. So I'm real estate every day of the week and twice on Sundays.
Oh, I love that. So your favorite city for real estate investments?
I do too. My 2 favorite cities. So when we buy buildings, we buy industrial buildings. My 2 favorite cities for industrial, which is, something we've done a huge chunk of our portfolio. I like Southern California, and I like the Texas Triangle, right? So you're right there. You're right in the middle. So we're my 2 favorite markets accidentally, but I like those because I like industrial. I think the next 10 years of the US is going to be the biggest industrial boom we've had since, the Industrial Revolution, basically in the US. We're bringing so much manufacturing back over to here into Mexico from China. And I think I like those 2 regions that I just said because of the shipping ports and because of the interstate highway systems that allow easy access to Mexico, and the ports that bring in from things like Southeast Asia. So those are my 2 favorite markets in the US. As far as mortgages go, we like the suburbs. The suburban markets around big cities, white picket fence, 3-bed, 2-bath. So I really like the suburban environments.
That's good. So, best piece of advice that you've ever received that has helped you in your business?
The best piece of advice I would say is it's from a book called The Obstacle is the Way. Okay. And it's that the things that you think are blocking you from being successful, if you're committed to being successful and you're committed to making progress, those are the things that actually commit you to higher levels of success than you would have had otherwise. So that book, Obstacle is the Way, is one that I return to every couple of years, and it resets my entire thinking. But it's that the biggest problems that you have, if you commit to growing through them and improving through them, are things that can be the biggest launch pad to take you to the next level. And that you actually need those in your life. You need those. So thank God for them. They're not just problems.
Thank God for all those obstacles sometimes. And thank you, Nic, for joining us here today. I appreciate your time. It's been awesome. I'm sure my listeners, they will find this episode really beneficial. Thank you for joining us, Nic.
Bola, I had a great time as always. Talk to you soon, my friend.
All right. Talk to you soon.